Markets continue to focus on the ongoing uncertainty around the U.S.-Iran peace talks, with rising tensions around the Strait of Hormuz putting oil back in focus. Now that's adding a fresh layer of uncertainty around inflation, central banks, and the path for interest rates. Joining us now for what it all means from a fixed income perspective, Hafiz Noordin of TD Asset Management. Always great to see you, Hafiz. Thanks for coming in.
It's great to be back.
We got a lot going on, as I was just spelling out in the introduction of bringing you into the conversation. How are bond markets reacting to this latest escalation in the Strait?
Well, it's definitely been a ride for sure this year, but it's kind of interesting. You kind of see where Canadian 10-year bond yields are right now, 3.4%. And guess where we were when we started the year? 3.4%. So, of course, within that, we've had a lot of movements. Before the war, bond yields went down all the way to about 3.1. And then with the escalation in the war in March, got as high as 3.6. So why all of this volatility? It's been the same story in the U.S., other markets as well, Japan, for instance, where yields are actually higher year to date, all because they import a lot of oil. So oil, as you said, is kind of really driving the bus here. And what the bond market's doing when it sees oil shocks, it's kind of the classic reaction we've seen over history. The bond market right away starts to price bond yields higher. And the reason is that they're pricing the potential for central banks to have to hike interest rates to potentially contain inflation if the oil shock is a prolonged one. So, so far we've seen it, for about a month or so. And right now, we've seen a bit of a de-escalation phase. So that's why we've seen bond yields come back to kind of where we started the year. So it's obviously all about oil. Again, it's this question mark of if central banks will actually have to hike rates or not. And I think it's still early to tell on that.
When we start talking about that inflation story, just saying the bond market seems to be thinking we get past this, we don't have to price in all that much in terms of an inflation shock. How quickly could that change for us?
Well, it all depends on the inflation, outcomes that we get. And, right now what we're seeing is that there's two ways to look at this. There's headline inflation, which has already shown kind of a bump up in March. The U.S. print came out and it was just close to 3.5% inflation rate. We're still waiting for the Canada print, but the market's expecting that to be around 2.5%. But what's important is to remember that headline inflation includes all of the components of consumption, including the volatile energy, gasoline-related consumption. Core inflation, which is kind of strips out those really volatile aspects, is close to around 2% in Canada, 3% in the U.S. So it's right now we're not seeing call it a spillover of the oil shock to the rest of the economy. But that is the risk, and we've seen that happen in the past, and it can't be ignored. And so for now, the expectation of the market is that if central banks have to consider hiking rates, it won't be right away. It might be something towards the second half of the year.
Let's talk about the central banks then. What kind of positions let's put them in? And all the time I've been covering central banks, there's always something complicating the picture for them. Let's start with the Fed.
Yeah, so for the Fed, it's they're kind of just right now on hold. At the beginning of the year, the idea was that they were still in this kind of restrictive territory with their policy rates, so maybe a couple more cuts would make sense just to get them back to what we'd call neutral. But with the oil shock, that kind of priced out those rate cuts, and now they're sort of expected to be on hold for the near future. With the de-escalation, though, we're seeing a little bit more recently. If that continues to persist, maybe there's a chance they can squeeze in one more rate cut. But for now, it looks like the Feds just kind of have to be a little bit patient here. But I think the Bank of Canada would be the more interesting one, and it's actually a bit of a challenging kind of environment for them where the economy hasn't been extremely strong. We have a kind of a weak housing market, and job growth has been kind of okay. But they started the year at a 2.25% policy rate. That was kind of the terminal rate. The Bank of Canada wasn't expected to do more cutting beyond that. And if anything, at the end of last year, we were seeing the chance of a rate hike starting to get back in the picture, not because of oil, but because job growth started to actually rebound. So there was already this debate of what the Bank of Canada would do later this year. And the oil shock has only served to kind of accelerate that trend a little bit. So when I look at the markets right now, I'm seeing about 1.5 hikes priced by the end of the year. I think in plain terms, that would mean that the market's expecting either an increase from 2.25 to 2.5 by the end of the year, or maybe they'll do even one more hike to 2.75. So I think that's the more challenging picture for Bank of Canada, where I don't think
it would challenge our economy too, right?
Yeah,
because our
exactly.
economy is not exactly gangbusters.
Right. Yeah. Exactly. Like I think I don't think they want to be patient right now, but the bond market's kind of nudging them in a certain direction. So again, for now they'll be patient. They know that rate hikes right now would be a hit to economic growth. But if oil were to consistently stay high towards the end of the year, I think because we have more linkages to the energy market in our economy, they'll have to kind of take the bond market's lead on this.
Talking about all the things that are happening on a macro level that affect fixed income, let's dig into where the opportunities might be right now, given all this.
Yeah, I mean, there's been a lot of volatility, but at the same time, there's been some pockets of resilience. And I think one that stood out is investment-grade corporate debt. When I look at, say, the Canadian market here, we're seeing yields on Canadian corporate bonds, investment-grade corporate bonds, around 4%, and that's versus cash yields of 2 to 2.5. So you're getting a good level of income in Canadian corporate bonds, and because they're investment grade, they've lived up to that name of showing resilience in terms of their business models, their earnings growth, and as a result, default risks are not very high right now in investment-grade corporate bonds. So, I'm seeing opportunities there, but I think with all of the noise and the shifts in kind of the macro picture around oil, there's sort of other kind of sectors, the software sector that's been coming up, sector dispersion and sector selection within the investment-grade corporate bond market is really critical. And so, it's been a good time to have energy exposure in a corporate bond portfolio. That's been doing well, probably can continue to do well if oil stays higher for longer. And then there's also other very defensive sectors, telcos, utilities, banks, that really have, nothing's changed in terms of their business models, but their bonds cheapened because there was this volatility. So I think there's been a lot of good active management opportunities in investment-grade corporates. And then I think the other area I'd highlight would be a little more opportunistic. It would be emerging market bonds, government bonds, that were doing really well and then got hit in March when the US dollar appreciated as sort of this safe haven effect, right? And anything that does well when the US dollar is weaker got hit a little harder, and emerging markets were one of them. But as we're seeing kind of, again, a de-escalation, and if that continues, I expect that emerging market bonds can continue its trend of outperforming, especially if the US dollar were to decline even further from here. So I think there's kind of those, it's nice in a portfolio construction context to have something that is pretty solid and resilient, but also look for these opportunistic ideas.
All right, so two interesting areas of the market. What about high yield? How's that looking right now?
Yeah, so similarly to kind of the broad rebound in risk assets, high yield's done well. It got hit initially, but has retraced a lot of the cheapening from March. I think for the most part, we can see a little bit more momentum to go. If we do get a true ceasefire that lasts, then high yield and equities will all kind of continue to rally a little bit more. But I think we're already back to valuations or credit spreads in high yield that are already kind of now back to what I'd call rich, well below 300 basis points, which is really pricing in no real kind of recession or anything like that. Not that I'd expect a recession anytime soon, but when spreads are at those levels, you have to be a little prudent and not over allocate to high yield. And so, I think it's just about being tactical. I think this has been the year to be tactical in markets like high yield.
So we're not really seeing signs of stress in those areas, but people have been concerned about private credit. There's been a lot of discussion about it, and a lot of discussions I've had with guests about it. What's your take on what's happening out there?
Yeah, if I were to distill it all down, I really think of it as two issues coming together. One is the kind of catalyst of all this, which was the stress in the software sector. And then the second is this liquidity mismatch between the underlying assets and what some retail investors are looking for, which is to get liquidity. So when I think of that, the software sector, it's all been about AI and the disruption of AI. That's impacted the business models of a number of software companies. We're seeing equities getting hit. And what's been happening in the last number of years is that a lot of private lending, direct lending, has been towards software companies, and so they make up a big part of, some call it sub-investment grade direct lending books by private managers. And as a result, they've come into sort of the hot spot here. But then that brings us to the liquidity side. And usually in private assets, most of that is held by institutional investors, which are truly buy and hold. And they do still make up most of the private assets. About 85% of private credit is held by institutional investors. So there isn't really too much of an issue there in terms of liquidity. They know to stick around and buy and hold. But it's the other 15% of the market.
Is that the 15% we're reading about in the headlines every
pretty
day in
much,
the financial press?
That's the retail investors that either didn't understand that this is sort of not meant to be a trading in and out instrument, or if it is, you have to know that the risk is more that the underlying asset is not liquid. So that's where a lot of this noise is going to come from, and I think will continue. But when I think about if it's a major risk or not, I really try to size the problem. Private direct lending is about call it $2 to $3 trillion market. But within that, if I take the retail portion of that, 300 to 400 billion, that's only 1% of the total global corporate bond market. So to me, when I look at and size the issue, I don't see this as systemic. It certainly brings to light that there are fundamental changes in some sectors, and you have to do your credit homework, whether you're in public bonds or private bonds. But and in totality, I think it's something that'll be cause noise and volatility, but really not a contagion to the broader corporate bond market.
We've covered a lot of ground. We're only into April this year, and we've already seen a lot. What are you watching going forward? What are you most closely watching going forward?
Yeah, I mean, I think that in the near term, come back to what we talked about initially, which was the risks around inflation. And I'd say core CPI is probably the most important macro variable right now. If core inflation stays steady at around 2 to 3%, then I think we can expect bond market volatility to stay contained. And I think it's also good to look at other ways of measuring inflation expectations. So next week, the Bank of Canada publishes its Business Outlook Survey. I think that's always an interesting read. It's a quarterly report that shows how businesses are looking at inflation expectations. So have my eye on that one.